The latest second half 2026 Global Outlook report by OCBC Group Research was recently published. While the world economy continues to surprise on the upside in the first half of this year, investors and businesses should not mistake resilience for smooth sailing. Here are the three most important takeaways. First, the growth story has changed. Perhaps the biggest change since the start of the year is that markets have put recession risks on the back burner. Worries about the US-Iran war has subsided, with the Memorandum of Understanding being signed. Crude oil prices have fallen sharply from the April highs of above $100 per barrel to the low $70 range in anticipation that ongoing negotiations to reopen the Straits of Hormuz will be eventually successful. The US economy remains in robust health, with a surprisingly resilient labor market. Several factors are helping. AI-related investment continues to boom. Businesses have adapted remarkably well to supply chain disruptions, and financial conditions remain supportive. Even in Asia, most of the first quarter 2026 growth cues have surprised on the upside. Momentum in the second quarter remains resilient so far, despite the energy shock. But the inflation battle isn't fully won, as energy prices will continue to take time to work through a wider range of goods and services, including transportation and input costs. This brings me to my second point. Central banks are clearly watchful about upside inflation risks. The interaction between geopolitics and inflation meant that central banks have pivoted away from an easing bias to a more neutral or even hawkish stance. At the start of 2026, many investors expected a smooth path towards lower interest rates, including for the US Federal Reserve. Today, that confidence has diminished. Major central banks have become much more cautious because inflation risks have resurfaced. A sustained de-escalation of geopolitical risks and the resumption of the global energy trade flows could allow economies to continue their soft landing growth trajectory. However, a prolonged geopolitical conflict could mean that central banks will maintain restrictive monetary policies for longer, and investors should therefore expect greater volatility in bonds, currencies, and equities, compared to the relatively calm environment many investors had anticipated entering 2026. Tighter financial conditions mean higher funding costs for businesses, and this could challenge valuation assumptions and corporate earnings guidance. The third takeaway is that Asia continues to look relatively resilient compared to many developed markets. ASEAN continues to benefit from supply chain diversification, intra-Asia trade, particularly for those economies that are plugged into the AI-related supply chain, as well as investment and wealth flows, particularly relevant for Singapore. Even if global growth moderates somewhat in the second half of this year, Asia's long-term growth story remains intact. The AI investment boom is both a tailwind and a headwind. Global spending on artificial intelligence infrastructure continues to provide a powerful source of economic momentum. That means technology, digitalization, and productivity-enhancing investments remain key long-term opportunities despite the near-term uncertainty. The global economy is holding up better than expected, but risks have evolved. Financial markets remain vulnerable to a hawkish pivot by the major central banks, including the Fed. This is in addition to geopolitical developments. For instance, the expected pullback in forward guidance by the new Fed Chair Kevin Warsh may actually mean more second-guessing and market angst ahead. Nonetheless, Asia's structural growth drivers, particularly AI, supply chain diversification, and rising intra-regional trade, continue to provide reasons for cautious optimism. That said, don't confuse economic resilience with financial market certainty.